Hi, everyone. I thought I'd start this session by asking three of the three panelists to just say a few sentences each about themselves and their company. So, Kathryn, you can start.
Sure thing. Kathryn Petralia, co-founder of Kabbage. And we're a real-time data and technology platform enables lending to small businesses in the U.S. and abroad.
John Sun, co-founder and former chief risk officer of Avant. And Avant is a large mid-prime lender that has multiple products, including unsecured personal loans, credit cards, auto loans, etc., to what we'd like to call the middle-class consumers in the US and UK.
Hi, my name is Chris. I'm the CEO and founder of iwoca. We are a small business lender here in Europe. We're lending in the UK and Germany and Poland, and have funded some 20,000 businesses over the last few years.
So, Kathryn, we learned from the title of this session that there's a bubble in alternative lending. But actually, your co-founder, Rob, he once said that alternative lending is dead. So which is it, bubble or dead?
What Rob meant by that was not that alternative lending is dead per se, it's that it's just now mainstream, it's just lending. So whether or not there's a bubble, that's a different conversation, but I think non-bank lending or lending to small businesses and consumers is alive and well, and I think most companies that are doing well are continuing to grow.
So we have two ways that we could talk about what a bubble means. I mean, we could talk about that there's a bubble in consumer lending or in company lending, that loans are being made that shouldn't be made, but there's also the question of valuations in this space. Let's look first at the question of the loans that are being made. What do our panelists think? Are we at bubble territory? Are we able to keep growing at the sorts of rates that we think that we are at the moment? Christoph, you can start.
So if I look at the UK market, you can see that consumer lending has come back to pre-crisis level in 2007, but we're also in 2018 now. So coming back to this level doesn't necessarily mean that we are in a bubble today. The Bank of England has called for some conservatism, and I think the banks have been reducing some of the growth in consumer lending. But if I look at the segment that I'm in small business lending, since I started the company in 2011, business lending has actually dropped by 10% in nominal terms, while the population of small businesses has grown by 30% in the same period. Business overdrafts used to be 60,000 per quarter, and they have dropped to about 30,000 approvals per quarter. So I wouldn't say that business lending is in bubble territory. If anything, the retrenchment of the banks really requires alternative lenders like us to come in to fill in the void that they've left.
John, what's your perspective?
I think looking at it from a consumer lender's perspective, lending to individuals in the US and abroad, like you said, you kind of got to first break down what exactly you kind of meant by bubble, and the closest analogy anyone really thinks of is kind of 07, 08, when the housing market was kind of in a bubble. And back then, if you look at underwriting standards, they were just completely divorced from reality, both on the originator side as well as the purchaser side of these types of debts. Whereas I think if you contrast it to today, there's certainly been a number of footfalls along the way over the past several years where there's kind of minor blips where maybe a particular set of rules was a little more generous than it should. But as a whole, I think both investors and originators are kind of watching credit standards like a hawk. Mm-hmm. I think that coupled with the fact there's been well-publicized kind of capital markets activity, asset-backed securitizations by all of the major players in this space, where all of that data is available for kind of public viewing and consumption, I think gives a lot of data out there for people to look at to keep us in check, to make sure we're issuing the right credit quality and make sure we're kind of writing the right types of loans.
Kathryn, what do you think?
I think it's very important to remember that the bubble, there was a confluence of events that occurred largely in the real estate markets. And so because of that confounding factor, we're not seeing that part today. I think there's a lot of controls in place to prevent that from happening and to prevent, the meteoric rise of home values that really contributed to that whole implosion, I think, in the market. So, if you're only looking at lending, you're seeing some things that happened, in 2007, 2006. There's some tiny little things, whether it's longer-term loans for autos, or whether it's a slight uptick in defaults, or whether it's, mainstream alternative lenders moving down market into subprime spaces. You're seeing some of those small things, but I think we're staying on top of it.
Yeah, and the data availability is essential in terms of the prudential regulation. Yes. Yeah. So I guess that point that Rob made about how alternative lending is now mainstream lending, It is, but not in terms of the institutions that are doing it. So banks have drawn back from a sector and you guys have stepped in. What happens if banks then say, well, we can do this? What do you do?
Well, I mean, if they did this, you know, there's a lot of space to fill like a 10, 15 billion void that they have left. But I think, you know, why have they left in the first place? I think small business lending has been a structural problem in 2011 when I started, and the problem has just become bigger over the last 7 years. Why are they not in this segment? It's a complex segment. We're providing financing to small businesses that typically turn over between 100 and 500,000 pounds or euros in Germany. These are complex entities that have been difficult for them from an underwriting perspective, costly to underwrite, costly to serve, and where it's more difficult to distinguish between low and high risk. Couple this with them being attacked on all fronts in consumer lending, I think it just has not been high on the bank's priority list to boost their SME lending, as regulators have stepped in to require them to have more capital on this. So the incentive structures, I think, that banks have don't really align with the segment, and the service they're providing to small businesses is exceptionally poor, and none of that has changed over the last 7 years.
So do you think that if we get through an entire business cycle, we see the downturn, your underwriting standards survive the test of a serious downturn, that you will then be so established that you can survive as alternative lending, but alternative lending has made it into the mainstream? Or do you think that's the point that the big players might look and say, we've been leaving money on the table here, we can just do what they do?
Well, I think it would be very healthy to have more competition. If anything, the number of small businesses that have turned to become permanent non-borrowers has significantly increased over the years, and it would be really welcome for the banks to come back and step in and to promote credit and compete with us on the market, where I think we have so many years of advance now that our service standard is so much higher than what they are offering their customers, that I think we would be surviving very well. We already have about 10% market share in the business overdraft market. So I think them coming back would be welcome. I wouldn't be too concerned on that. Competition is a good thing, so particularly in a market that is structurally and chronically underserved by capital, I would welcome that very much.
Kathryn, you license your product to banks so that you help them to compete in this space.
We do, in fact, although most of that is happening in Europe and around the world and not in the US. Though we're open to those conversations, getting back to, I think, the point you made earlier about are banks going to do this themselves. Historically, banks have licensed technology from third parties for almost everything they do, whether it's risk management or core banking services or credit card acceptance or money transmission. They use lots and lots of third-party technology companies. I think it's a little bit different in this case because companies like ours, we actually are direct lenders to these small businesses. But I think it's also important to reinforce they never served this market before. They don't know how to do it. And user experience is so important. And we're able to do that by using data, this real-time access to third-party data that allows us to react really quickly to our customers' needs and also to manage risk in the event of a bubble or a downturn or bad things that happen. And I think that's a really big distinction between what we're able to do now and how lenders were able to react in 2007 at the beginning of the GFC.
So we're talking to a very sophisticated audience here, but still trot us through the sort of, the 3 steps or so, very superficial level of what it is that's different now than was 10 years ago in terms of the data.
Well, for one thing, and it's different with consumers than it is with small businesses, but in general, the ability to access real-time checking account data is really important. Whether you're doing it for KYC or whether you're doing it because you want to verify income or whether you're doing it because you want to see real-time cash flow in a business, it allows you to see performance in consumer and small business right away. So rather than using a credit report, which is a lagging indicator of performance, maybe, or versus actual access to is this consumer getting paid? Is this small business getting revenue? Those things are really important. I think that is probably the key point that overshadows all the others.
Mm-hmm. And from your point of view, John, what's changed? What's the big difference over the last 10 years?
Yeah, I would definitely echo kind of both what these guys said. And what's really interesting is I think they're obviously talking about it from a small, medium business or B2B perspective. A lot of the same rings true for B2C, which is basically The banks don't necessarily want to compete in the segments that we want to compete in. They've basically built a business around optimizing for certain things, which for the banks is optimizing for cost of capital, optimizing for how to best utilize their customer base, whereas we're optimizing for acquisition channel and conversion and how to most effectively acquire a new customer, how to most effectively underwrite kind of a difficult credit risk to underwrite. And as a result, I think there's always going to be some amount of complementarity between the alternative lenders and the banks. And Avant actually, similar to Kabbage, also distributes a product called Powered by Avant that's used by some of the top banks in the US and today, and starting to have those relationships overseas as well.
Mm-hmm. So we've seen the introduction of much stricter and more specific rules about data recently here in Europe. I mean, two of you are in Europe and one of you is, well, you're in Europe, but you're based elsewhere. And what specific challenges does the GDPR bring for each of you? We'll start with you, Christoph.
As a tech company that has been relatively recently built over the last few years, I think we are in an advantageous position that we know the data that we have on our customer very well, and we know exactly where it is. I think the problem is for companies that have data in all sorts of systems that are not really combined to understand how they put this together so that if a customer comes and wants that information, that they can deliver it. So the challenge for us was probably much smaller than it is for certainly all of the banks. And I think what it does, it puts the customer more in control. And it just increases the stringency that in a privacy policy you see what the data is used for, which generally I think as a consumer is not necessarily a bad thing in today's world. But it wasn't a massive challenge for us because our systems have just been built to be GDPR compliant from the outset.
It sounds then like it's actually an advantage, because if something's hard for you but harder for other people, that's an advantage.
Well, I would say banks should now have a better control of the data that they hold on their customers. So to a certain extent, if they have done the work, they have leveled the playing field to us.
Yeah, but the work is expensive.
But it was expensive, and
yeah.
I think if you look at budgets that banks spend on regulatory issues, they're huge, and it's generally related to the outdated legacy systems that often have been put together in various acquisitions and are completely incompatible with each other. And I think they are now paying the cost for this sort of not very modern way of building a technology infrastructure.
When you're dealing with consumers, are there extra challenges that GDPR imposes? You've got more and more fragmented and different sorts of data, I presume.
Yeah. Similarly, I think because our systems are constructed much more recently than the banks, there's already a lot of thought given to partitioning of data and all of these things that's kind of required by GDPR. And there's similar kind of requirements placed on you, not to kind of the same extent through FCRA compliance or through PCI compliance or through SOC 2 compliance and all of these kind of various regulatory regimes. So the technology is designed from the ground up to kind of be ready for it. So it is additional work, but like Christoph said, it's not a ton of additional work, and it's certainly something that kind of we were able to meet a fairly reasonable schedule.
Kathryn, does it put off American firms moving into Europe? I know you're already here, but what do you hear?
Well, I think, again, if you're a technology company, it's a lot easier. We spend a lot more time and money on defining roles and responsibilities and policies and training than we did on actually doing the work because, again, the data is more accessible and more centralized for us. So, I mean, I think for tech companies, it's just another thing you have to do now. And you just, move on. It's certainly worth it. And, at the end, the goal is to protect data. And I think everybody can get on board with that.
And I would just add that it's probably even easier for a fintech company than a normal tech company. I think the main differentiating factor is that fintech companies generally have, reasonably good compliance procedures and controls. Just because we're day in, day out working with pretty sensitive data, working with large banks. And it's really just kind of, at least at Avant, I'm sure, similarly at your organization, it's really just bred in as a part of the culture of fintechs.
Let's talk about those valuations, the other words that bubble gets attached to. So we've seen some very fizzy valuations over the last few years on occasion, and those are predicated on really enormous growth. But there are natural limits to the sort of the growth in the businesses that you're in. Let's talk about that a bit. Who wants to start? Nobody. Christoph, you've been nominated.
I mean, we've been growing above 100% for many years in a row.
Sorry, say again?
We've been growing above 100% rate for many years in a row. And I don't necessarily see why this should be stopping this year or next year. The market is very deep. And we have been just really good in building technology to serve customers at scale with a low fixed cost platform. And I think that's what investors value, which is why they're paying up for valuation, for getting access to relatively rare assets like some of the tech companies that have raised funding recently. And so I'm not necessarily thinking that this is in bubble territory. It really depends on a company level. Do you believe that they can grow as they have done in the past and as they say they do? And you buy into that story, and you expect that they deliver on that.
So with a 10% market share with 100% growth, it doesn't take much to do the sums to see that, you're lending to people beyond this Earth and into other galaxies rather soon. So I'm not trying to make a point specifically about your business, but, sometimes it seems to me there's a disconnect between this history of really spectacular growth and just the room there is left to continue to grow.
But then we are really filling a void. When I say we have 10% market share, the number of just quarterly approvals in business overdraft have reduced by 50% over the last 6-7 years. So I have as much market share in the unserved demand than I have in the served demand. So you can sort of look at it. Can I take another 10% or another 20% of the unserved demand? Then this number doesn't look so big anymore.
So if I was a regulator listening to this, that would make sense to me, but I would also remember that the last time people started serving unserved demand, it didn't really end terribly well 10 years ago. Expanding markets is when you go down into your weaker credit risks and your people with less data.
I think there's multiple ways to expand markets, right? There's certainly kind of responsible, sustainable ways of doing it, and then there's kind of ways where you just hack at it and you say, well, I'm just going to loosen XYZ criteria to create artificial loan volume demand. And largely what we're seeing is more responsible growth of potential markets, like similar to what Avant's doing, what Kabbage is doing, looking into complementary products that you can leverage your same technology for, working with banks. Avant just recently launched its credit card product, which is aimed at a slightly different customer population that's also underserved. So there's a lot of underserved customers out there, right? So I think if you look at a narrow definition of what it is that we do and say, well, you do unsecured consumer loans, how can you continue to grow X% per year? That's very much true. Like, there's going to be a natural cap to that. But in terms of unmet, unfilled consumer demand, there's a ton of it out there, right? And the banks are really good at serving the prime and super prime. And I think Avant focuses on the near prime and the non-prime. And from that perspective, there's a lot more products, there's a lot more geographies we can go into, and there's a lot more we can leverage our platform to create kind of complementary value.
And we have better tools to manage the risk than we had 10 years ago. So I think that's a really important distinction. Although I wouldn't say that all of the growth is happening in this near prime or non-prime market. I think there's another side of the bubble. It wasn't just about growth that drove valuations. It was also because, and I don't mean to talk about any companies in particular, but in the US there are two public companies that had valuations that were based not only on growth but also on technology. That they were technology companies, they were the analysts that covered them were technology analysts, and if you need to hire people to grow your portfolio, then you're not really a technology company. And so I think that the industry's been painted unfairly with the same brush. I think there's a lot of value created when you can use technology to serve more customers with fewer people more cost effectively. And on top of that, if you have this huge stable of customers, it's important to be able to give them other products and services they can use. And that allows you to continue to increase your LTV for that population. And I think that's what you're seeing happening with Square and PayPal. They're moving into other markets. They're starting to add lending to their payment processing. And I think you're going to see that kind of growth from the big companies because they know they need to be able to take advantage of the customers they have.
So the other way that you could ask yourself the question about where you fit together with banks, rather than saying that banks could look at what you're doing, wake up and say, well, we could have done that and not left this space, is you could start doing more of what banks do.
Yeah, and I think it's a really interesting discussion that we have on valuations. So I think you have one camp that is starting more as a digital bank, digital account, that is very successful in offering a better day-to-day service than banks are, and you can see in the sort of massive flux of customers that goes to these services that they're offering something that clearly, the banks don't, because otherwise these people wouldn't switch. It's actually very hard to make people switch from their bank to another service. And then you have lenders like us that have come more from the credit side, and I think ultimately, over the next 5 to 10 years, you will see some of this converge. And I think that's going to be a much more difficult point in time for banks when they see that they have waited for too long to actually invest in the customer experience. Their customers got so disengaged with them as banks moved them more and more to relatively poor phone systems or web applications, which make it much easier to switch because you already weakened the relationship that customers still value today so much. That they're just going away in scores. So I think the credit and the digital accounting side or digital bank account side, I think there's a really chance that this will be sort of the disrupting element for banks where they're seeing customers go.
Where you meet the two sides meet in the middle and there's nothing left. There's no space left for banks.
Yeah, and I think companies like Square are great examples where you see some of this already happening.
Do you think it's possible that we might in 10 years' time be chairing a panel or running a panel that says something like, can banks survive?
I hate to say this too. I know there are probably a lot of folks from banks in the room, but I mean, they're running the risk of becoming just utilities, upon which everybody else is building great tools that provide a great user experience because that's what customers want. And maybe that's okay. Maybe that's a great thing for them to do because it is highly regulated. It is very much like a utility. So we may be talking about that. I wouldn't even call it unbundling. That was a thing from a couple of years ago everybody talked about. They were already unbundled.
Right. Now, I spent some years living in Brazil for The Economist as the Brazil correspondent, and at the time, people were talking, very much about what they call the Class C in Brazil, meaning the new consumers, people who had their first bank account, their first phone, maybe sent their children to some, private coaching for education, that, first consumers. And that was what, at the time, was the fashion for talking about digital inclusion or financial inclusion. But we haven't talked about that at all yet, moving to serve the billions of people in countries, which are rapidly growing. Not that Brazil is, but, do you see that as your next space? Or do you think that, you're in the UK, you're going to stay here and keep serving?
We're also in Germany and Poland, so
yeah. But that's not the new middle class.
In the first in the very fast-growing emerging market space. And I think from a credit perspective, it's not easy. It's not traveling as well as foreign exchange. Credit is typically very regulated on a local basis. The data is different in different regions. So as attractive as it is, and I think at some point, as we grow, might become a real option to go into some of these markets. It's just difficult to operate as a credit company in many, many different markets as seamlessly as some other business models can.
Mm-hmm. But I think we're seeing some changes in some very large emerging markets, everything from digital identity to access to real-time information about consumers and small businesses. As that data and infrastructure becomes more available, it makes it much easier to move into those markets and as they become less fragmented.
I mean, India is a classic example.
Yes, that's what I was thinking of when I was saying.
Yeah. I mean, is that something, and I'm not asking you about your own companies now, but just in the space and from going to events and talking to people, do you see any big companies making some bold moves into these places, or are they going to have to be indigenous, their own companies starting from
in
scratch?
India you see both.
Yeah.
I think it's certainly doable. I think the track record generally for non-indigenous, finance companies outside of like continental Europe has been pretty poor, just because there's very different regulatory regimes and structures throughout all of these places. You really have to know your acquisition channels if you're a non-bank or at least non-kind of startup, or I should say startup acquirer of these types of customers. And you really need a deep understanding of not only kind of the finance market, but where do people go for money, where do people go for services, and these types of things. So on some level, and we've looked into kind of providing technology, certainly, to lenders in other spaces, but not necessarily to go into a market that's very different from kind of the existing developed markets that we know well. On some level, you might see more partnerships like that, maybe Avant or Kabbage providing technology to an indigenous lender who understands the market, can acquire the customers, and can drive the rest of the value creation process.
In some ways, I think this is a very, very positive sign because it's just, it's cautious but not, it's not reckless, but it's cautious. It's a good sign, I think, for the industry that people are taking that sort of let's wait and see and let's work in partnership approach. I want to ask each of you, you can choose to answer just one of these questions or both, and choose which one you want, and it kind of indicates whether you're optimistic or pessimistic. What's the thing that you've seen recently that has surprised and delighted you most, or that has worried you most about this space? So I'll give each of you a couple of seconds to think about that, and just tell me something really interesting that surprised and delighted you, or that worried you a bit. Anyone got any thoughts?
I think I'm generally surprised and delighted about the end customer's interest in sharing data with trusted third parties because they know that there's going to be a benefit to them. People told us as we were raising money, 10 years ago, no one's ever going to give you access to that information. It's never going to happen. But what I'm seeing is that, customers are really excited about making sure that they are in control of their data and that they have the ability to give it to people for their own benefit. And there's so much more education about that happening today that I think it's making people more comfortable. And of course, there are going to be bad actors, but I think there are a lot of good actors in this space as well.
And yet anything that makes you worried or pessimistic, even small signs?
It's funny, I heard a couple of weeks ago, I was at this event, and I heard a very well-known news person say that they were terrified of AI and they thought it needed to be stopped. And I was terrified by that statement.
John, what about you?
I'm certainly encouraged. I think it seems like the mainstream banks are starting to take more of a notice of this space, and I'm encouraged that, again, based on the conversations that Avant has been a part of, it's generally very kind of complementary type conversations rather than saying like we want to get into X, Y, and Z that you guys are doing. I think mostly because the credit risk appetite just isn't there. So that's certainly great, I think, from a market development perspective, as banks provide kind of better user experiences to all of their customers by partnering with the guys who can provide that experience.
And have you heard anything that worried you or scared you recently?
Not really. I mean, I think as an industry, we need to be cautious. I think again, there's been faults in the past, but as a whole, we've been pretty cautious around credit risk, and that's just one of these things that I think it could kind of go down a slippery slope very quickly if kind of large lenders stop paying attention to it. Certainly, I think over the past several years, we've had some of the best credit environments we've ever had. Is it going to persist forever? Certainly not. But it's difficult to say exactly kind of how that progresses and what that looks like.
But you have at least some faith in the idea that the enormous amount of data has changed things from 10 years ago. Yeah. What about you? Surprised and delighted, or worried and scared, or both?
I'm really delighted about some of the huge successes you can now see in fintech coming through after the many years that people have been talking about this. But companies like Revolut or other neobanks have really demonstrated that they can attract millions of customers within a relatively short period of time. And I think that goes a long way of showing that consumers are now ready to switch. And banking is one of the industries where you see most inertia. And I think we're kind of now in the next few years where this inertia is finally being broken by A, consumers willing to switch, and B, the offering of companies like us just being so significantly better. You couldn't quite say that 5 years ago, as all of us were in our infancy and doing the first customer transactions. And I'm really delighted by this. So I think that goes a long way of showing that the next 5 years we'll see more excitement. I'm concerned about political risk. Wherever you're looking at, you see trouble, whether that's in Europe or the US. There's certainly much more political risk today than there has been in the past, and I hope that sort of means that anyone is more cautious on the risk side, so it actually can extend the sustainability of the market. That's a positive of it. But hopefully we as operators in the economy can keep our calm as politicians seem to make things more complicated than they have to be.
Thank you very much to my panelists. We're out of time.